Good morning to the West Coast, Central United States, and good afternoon to the East. My name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. We have about an hour and 13 minutes together today. It'll give you an opportunity to find out a little bit more about the center, what we do, and most importantly, one of the industry's top producers, Simon Singer, is going to talk about the tools that he uses to deliver the top 1/10% of all production in the U.S. on a year-by-year basis. So we get good insight to get into Simon's head. For those of you that don't know Simon, he's been in our industry for since 1966. He's written 4 business bestsellers on our industry. He's a very sought-after speaker and a member of some very prestigious organizations and groups, including the Financial Planners Association, members of the Advisors in Philanthropy. He's the past president of the International Forum, and he's the recipient of the National Humanitarian Award and the founder of the Center for Tax Strategies and Resources. Ladies and gentlemen, please allow me to welcome Simon Singer.
Let me suggest that I think people rush too quickly into selling something to somebody, and they develop what we've learned to call commission breath. People can smell you coming. And it's really important to spend a lot of time finding out what people are about, not just what their finances are, but find out what's going on in their head and their heart. I learned an expression a long time ago. Wealthy people especially have a lot more going on in their head and their heart than they do in their pocketbook. And all people in our industry have been trained to do is talk to them about their pocketbook. So if anything, I'm going to give you a little bit different perspective on how to orchestrate the conversation. We're not going to have time to do that today because you asked me about what are the tools. So the first tool is the goals and objectives sheet. Very important. We could spend a whole hour on not only how to get that filled out, but how to then ask questions after the questions after the questions to get down to some real detail and get people committed. If you don't get people committed, I don't care how good your product is. I don't care how good your strategy is. I don't care how good the numbers on your page are. It's irrelevant unless it's attached to a goal and objective that the client has said, yes, this is what I want to do. How do I go about doing that? It's incredibly important.
Well, I've heard you say 1,000 times, if I've heard you say it once, that the biggest mistake you see a lot of advisors make is leading with product, because if you lead with product and you don't get through to the client, you've got nowhere to go.
It's true. You back yourself into a corner and you can't get out. Yeah. So doing discovery is very important. So we're going to start this session today, assuming that we have done some discussion of goals and objectives and me getting a bunch of information about their finances, despite the fact that I just got done telling you don't spend a whole bunch of time on finances. But I want to show you how to use this tool. This is a tool that we buy from a company called Insmark. The name of the tool is Wealthy and Wise, and it's just part of their suite of offerings. We don't use all of them a lot, but I use Wealthy and Wise on every single case, whether I show it to a client or not. I use it to prospect with CPAs and attorneys, and I use the results, and I'm going to show you the results in a minute, and then I'm going to show you how we get there, which will take more time. But total input time on this system, once you learn how to use it, is maybe 10 or 15 minutes. It's the scenarios after the initial scenario that you can illustrate anything from a sale to a defective trust, to a self-canceling installment note, to gifts to irrevocable trust, to the sale of any kind of asset. It's truly incredibly simple to learn how to use, but there is a learning curve. So Brad, you remember how much that system costs, right? Because we reviewed it yesterday. What's it? $1,500 initiation fee.
It's $15.99 initiation fee and $65 a month for Wealthy and Wise, and I think it was $45 for the illustration software and $8.99 one-time setup through Insmark.
Yeah, we're not selling this. We're just telling you this is a tool that I use all the time, and we make available to the members of the center on a very, very, very steeply discounted basis. We're not going to get into that today, but I just want to show you a few things. First of all, I'm going to take you to an output sheet. Now, I needed to find out where their assets were and where their liabilities were. So this particular individual is ages 65 and 60. The hypothetical name is Matthew and Catherine Fox. They're worth $6,833,000. They got 600,000 in liquid assets. They've got 833 in tax exempt assets. They've got 2.2 million in equity assets, and they've got 1,650,000 between the two of their defined contribution plans. So their liquid assets are $5,333,000. Their illiquid assets are $1,500,000, and they don't have any life insurance. So next, what I want to show you is what the assumptions are. We assumed a 35% tax bracket. Their joint life expectancies were 29 years. Matthew would have been 93. Catherine would have been 88. The interest earnings assumption on the CD, so you can tell how old this is 3%. The tax exempt yield was 3.5, and they had two mutual fund accounts or equity assets, whatever you want to call them. We had the growth rate at 7% on each of them and the dividend rate of 1%. The defined contribution plan was earning 8%, and there were two defined contribution plans. So both of them were earning 8. If I had a management fee, it would have been subtracted from that, and income taxes are going to get subtracted depending on whether it's qualified plans or not. Yeah, Brad?
Yeah, having built several of these with you, admittedly, I am not great with Wealthy and Wise, but I'm getting better every time we do it, but I still need your help going through it. Part of that process with the client is eventually getting sign off on those assumptions you used, correct?
No, absolutely correct. These have to be their numbers, not yours. And you'll see why in a minute. It's really important that, and we talk about spending time in discovery. Well, don't you think it would be important to know what they expect their investment portfolio, what kind of rate of return? You know, when did they think their life expectancy is? Some people, I mean, we've got a woman doctor client who swears she's going to live to 105. It doesn't matter whether I agree with her or not. What matters is I need to create something that matches what her interpretation of her various situations are. When we plan, we like to plan on people having too much money, not just barely enough. If I make a mistake, I want to make sure that they have more than what they thought they were going to have as opposed to less. If it's less, I'm a bad guy. If it's more, they were expecting it. I don't even really get much credit for it. So let me go to the next page because I don't want to waste a whole bunch of your time. But these are the assumptions to remember because we're going to use them consistently throughout the scenarios that I'll show you in a minute. So this is the cash flow analysis. So we've got three columns here. We've got annual cash flow required. They needed $200,000 net after taxes, after tax spendable cash flow, $200,000, increasing by 3% inflationary rate each and every year until they got to around age 85 years old. And then we flattened it out. Even though they're going to have less purchasing power, they're 85 years old, they're not going to be spending as much money.
Hey, Sam,
column,
I'm sorry. Can we expand that a little bit? Can you take that up from like 94 to 110? It's just a little tough to see.
Sure.
That's much better. Thank you.
Okay, so notice here it stated 350,701. Even though the inflationary increase would have been substantial, they didn't feel that was necessary. But again, that's not my decision. That's their decision. So columns 4, 5, 6, 7, and 8. 4, 5, 6, and 7 show where does the money come from. I'm not going to take you there right this minute. I'm going to take you there a little bit later in this presentation. But expected cash flow could be Social Security that both of them had earned. It could be after-tax cash flow from retirement plans. It could be after-tax cash flow from taxable and tax-exempt accounts. It could be cash from equity assets, and sometimes there's even an excess over and above what they need to maintain their lifestyle. That would show up here in column 8, and then it would be reinvested someplace, which I would direct it to later on, but we're not there yet. The main important thing here is $200,000 a year, net after taxes, indexed for inflation is what they need. That's what we've got to make certain that they're going to have enough money to maintain their lifestyle. If they don't, this column over here is going to start showing up in red. And if it starts showing up in red, that means they've run out of enough liquid cash to be able to provide the amount of net after tax income that they need to maintain their lifestyle. And then lastly,
sorry, and seeing you've plugged in inflation rates and assumed rate of return, so you've got a pretty decent accuracy level on what those income streams are going to look like.
Yes. Okay. Now, after providing the required cash flow on an annual basis, This is what their estate is worth. I think it was originally worth $6,833,000. All right. So now it's worth $6,817,000 because I haven't had time for the money to grow, and I pulled out $200,000 net after taxes. So the total transfer taxes are $623,000, which is basically the income in respect of a decedent on their qualified plan assets. I think the number was about $1.5 million total, if I remember correctly, but we can find out quickly enough. $1,650,000 and a 35% tax bracket. So here are the estate assets. I'm going to take you all the way down to the bottom. I want you to see that at 93 years old, they got $16 million of estate assets after providing the annual required cash flow. The taxes are going to be $2.8 million. The heirs are going to receive $13 million, and the year-end wealth transfer is going to be $13 million. There's no planning here. All this is just a baseline. It's a baseline from which I work and from which I plan. Now I'm going to go out of this system, and I'm going to go into a summary because there are 26 pages, I believe, in this. Everything from their equity assets, how they grow, what the turnover rate is, what the yield is, what the earnings are, what the taxes are in the distribution, did they take a distribution, et cetera, et cetera. What I'm going to do is I'm going to show you 5 scenarios, and each of the scenarios are going to work off of the information that we've just reviewed. And for members of the center, they get a chance to review this over and over again. But I just want to show you how incredibly sensitive and attractive this type of software is. So give me 1 second, because I'm not technically terribly proficient. Lo and behold, I got to where I wanted to go. So here's the number: providing required annual after-tax cash flow of $200,000, indexed for inflation at 3%. Life expectancy 65. They're currently 65 and 60. The life expectancy is 93 and 88. Their current net worth is 6.4. Here's what happens: total estate assets $12.2 million, taxes of $400,000, net to heirs $11 million, cumulative net income $8.5 million. However, there are algorithms in this software. Algorithms in the software that can determine which asset should they access at what time and in what amount in order to maximize. Could be net worth to heirs, it could be gifts to charity, it could be increased income, or any of the combination of the above. So well, this we call this not. Yeah, I'm sorry, Ben.
Which you have the insight for because you did goals and priorities to get into their heart, not just their head and their wallet.
Absolutely. And in this particular case, what they wanted was more income and more money to charity. So notice here, there's no money to charity, $11,600,000 of the heirs. So if I go down to, I need to go to here. Give me a second. This needs to gear itself up. Okay. All right. So the efficient scenario, meaning let the software solve for which asset in which amount to maximize the money to heirs. Well, just by letting the algorithm solve for that criteria, instead of $12 million at age 93 and 88, it's $18,800,000. Because the net worth is greater, they're going to pay $4 million in estate tax as opposed to $400,000 of estate tax, actually income in respect to the decedent tax. But the main issue is the heirs are going to receive $14.8 million as opposed to $11.6 million. No planning, still no money to charity. We haven't made a sale yet. Notice the cumulative net income is still roughly $8,530,000. Next, what if they said, well, we don't want to disinherit our children, but we would like to see how much income we could derive. So now the assets don't grow to 18 million, but they grow to 13.5 million. The taxes are going to be a little bit less, 2.1 million as opposed to 4 million. The heirs are still going to get 11.3 million as opposed to 11.6 million. That was okay with them. We could have played around with the various numbers and come up with an exact number. We didn't bother. But notice over here, instead of 8.5 million of positive cash flow, net after taxes for their own lifestyle, we're able to get them 10.7 million. Now you must accept for the time being that the tax brackets, the yields, and the turnover rate are all unchanged in each of these scenarios. For the time being, just accept that as true. Well, I've accomplished the first goal. I haven't done any planning. I haven't made any money other than charging a fee, but I haven't made anything other than that. So now let's go for that. Now let's start to do a little bit of planning. We bought some life insurance for about $60,000 a year. So the net worth was 11, and I'm sorry, I also want to use the increased cash flow for mom and dad. So the estate's going to $13.5 million, still $2 million of transfer taxes. The heirs now get $18 million as opposed to $11 million. Charity still gets nothing. Mom and dad still get $10,700,000. And then lastly, now we do a little bit of planning besides selling them some life insurance. We make a testamentary gift of their qualified plan assets whenever they pass away. That's the extent of the planning. Well, the estate has grown to $15.3 million, $468,000 in transfer taxes. Why? Because I'm not paying income in respect of a decedent and estate taxes all at the same time. The heirs get $15 million because I got some life insurance. That's better than 11 where they were. Charity gets $4.4 million. That's better than 0. And mom and dad still get just $20,000 short of $10 million. I can tell you right now, most people want to know what the bottom line is. We got 26 pages of data for each of these scenarios. So what is that? 26 times? That's 105, I think. No, a little more. 131 pages. The fact remains is they just want to know that you've got the documentation there. But each of these took about 5 minutes of additional input in order to come up with these various scenarios. This is now built into the software. And this software is available directly from Insmark if you want it. But let me go back now and let me show you. Now, this is going to be quite a test whether I can get back or not. So let's see. I'm going to here. Todd is shaking his head yes. So I'm going to go to current and I'm going to go to edit. Actually, I'm going to go back for a second because I want to do something different. Software is a little slow right now. Okay, whenever you decide to wake up, here we go. Now I got to go back again, and I'm going to tell you why. Because what I'm going to do is I'm going to wipe out all the information and I'm going to re-input it. It probably isn't going to be exactly the same. In order to duplicate current, I go to here and I say copy, and a whole new scenario, copy of what we've got listed as number 1 current is now going to show up on the screen. And here's copy of number 1. Everything is identical, but I'm going to go in there and I'm going to get rid of most everything. I know of a few things. I can't remember all of them, but I'll show you what I'm going to do. So the preliminary data I'm going to leave the same. Here's the desired cash flow. Notice here it says $200,000 net after taxes indexed for inflation. I'm going to take it out. I'm going to input 0. If I want to input $200,000, I go in here and I put 200,000 and I hit apply, and 200,000 shows up every place. It's got 3% inflation. If I wanted that to be 0, it could be 0. And then the number it's in the second column will equal the number in the first column. Now I got 200,000. I want to go back. I want to put 3% inflation in, and there, and lo and behold, it shows up. Okay. Now, if I had any other expenses, I could do them here. Plus, I've got all kind of drop-down boxes. I could dedicate cash flow for a new roof on the house, or every 5 years they're going to buy a new car, or they're going to take a trip around the world. But I didn't have any, so I didn't bother putting any in. Expected cash flow. Number 1, I've got Social Security. I'm not going to go bother back in and recreate that. Actually, yes, I will. So I've got 20,000 plus 21,000 plus growth. So I'm going to make that 0. And then I'm going to go into this Social Security calculator, and it's going to ask me information about the client, what their birth date is, et cetera. And while they were working, did they earn more than $142,799? I'm going to say yes. The wife wasn't working at all. I'm sorry, the wife exceeded $142,799. And after they retired, they were making over $44,000 a year. And I'm going to hit OK. And all of a sudden, all of those numbers show up. I got 3% inflation again. If I didn't want any inflation because I believe the government's going to go bankrupt, I'd hit 0. And all of a sudden, these numbers equal each other. So I'm going to go back in and put 3% in there. This is not brain surgery, ladies and gentlemen. All right, I'm going to hit OK. Now, that's interesting. I don't know why that showed up right now. This is investing. Where am I going to reinvest any excess cash flow? Well, if I remember correctly, they didn't have any excess cash flow, but I have to tell the system if there is excess cash flow where they want to invest it. So I'm going to go back now into expected cash flow. We just did that, sorry. Now I'm going to go into retirement plan assets. This says he's got 750,000 earning 8%. The spouse has $900,000 earning 8%. There is no management fee in either case, but I could put one in just by clicking there and dumping a number in there. I've got places for inherited defined contribution plans. And by the way, defined contribution would be defined as money purchase pension plan, profit sharing plan, 401k plan, IRAs. Everything else would be in the defined benefit column. If I've got a Roth conversion in here, it's going to ask me for the information. So let me take this out right now. Now I've got 0 as opposed to 900,000. And I go to the client who now has 0 as opposed to 750,000. And I go back in and I put in $750,000. Oops, that's 75, not quite the same. 75, 1, 2, 3, 4. $750,000. The spouse had $900,000, so I'm going to put that in there. Now she's got $9 million. I'm a heck of a planner. 900. I'm not going to bother changing the yield. You see how I've done that. If I want to put a management fee, it's in there. Here's some magic down here. By the way, I've got Roths, I've got inherited Roths, I've got defined benefit plans. If I clicked on defined benefit plan and wanted to include it, this is a flaw in the system because the only thing it gives me is it gives me the annual distribution that comes out of a defined benefit plan. So I don't use this section. What I do is I roll the money hypothetically into a defined contribution plan and then pull the money out of the defined contribution. Otherwise, if somebody's got $2 or $3 million in a DB plan, it doesn't show up any place, and that gives an unfair comparison. So I'm not going to use that at all. So let me get rid of that defined contribution. Then I go to liquid assets. I don't remember what they were. Well, it doesn't, I don't have to. They got 600,000 in a CD. If I want to include it, I click that little button, it gets included. My yield was 3%. If they have a second account that's taxable income, I put it there. Then I start telling it, how do I want it to withdraw the funds? And I'm going to go back. I'm going to go back for a second. I hope that's not too confusing. I'm going back to retirement plan assets. I've got the ability to pull the funds out in any order I want. I can pull them out first. I can use them as any other asset in order to provide the necessary cash flow. I can pull it out according to required minimum distributions and never more. I can pull them out per schedule, which includes the required minimum distributions and more if I need it, or per schedule, which includes the retirement minimum distributions, never more than that. I can use a level after-tax distribution that deplete the account starting at whatever year I want, ending at whatever year I want. That's a big planning tool. If I want to use SPIAs, it's a place up here. I have to put the details of it in, but this is just, this is so monumentally simple that even while I'm explaining it to you, maybe it'll take 10 or 15 minutes. Yeah, Brad, sorry.
No, I was just agreeing, because that going through the level of detail that you get to input, drag in and drag out. You know, Simon, the thing that to me that I love about that tool is when I go back and present the solutions, I mean, I'm using that one center page, right? So you've determined what point A is and then talk about options B or C. There is absolutely no way that a client doesn't pick either B or C because it's answered all the questions that they've had. And it's because of the level of detail you've gotten here. But the one reason I was cutting in there is I don't have to go through the 35 pages behind the one to be able to explain the concept to the client. I have that there for the CPA.
I'm going to take and show that to you in a minute, just how relatively simple it is to gain the credibility that the numbers aren't flawed. I'll show you that in a second. I just want to get through this. You've seen the liquid assets. I've got taxable accounts. I've titled them CD. I put in 600,000. I put in the yield. There is no management fee. I tell the client, I tell the system, how do I want to withdraw the funds? Or I've got tax exempt assets making 3.5%, 833,000. I tell the system when and how do I want to pull out the funds. I'm not using the algorithms at this point. I'm basically just telling it what I want it to output. Then I go to equity accounts, mutual funds, 1,000,005, 1% dividend rate, 7% growth rate, 20% tax on the dividend. How do I want to withdraw the funds? What about the portfolio turnover rate? I'm not in the securities business, but it's something that people really would like to know exists, that they get a chance to analyze it. Because if my turnover rate is once a year, I've got ordinary income tax, not long-term capital gain. Then I go to the second equity account with the word 750, same exercise. I've got nothing in tax deferred accounts. That would be their annuities, because I'm going to pay taxes on the distribution. And when I get to the end, I'm not going to pay tax on the principal. If I go to illiquid assets, I've got a home, I've got some personal property, I've got a vacation home, and that's it. But I've got 10 boxes here of different types of illiquid assets. It can be real estate investment trusts. It can be an apartment building. If it's an apartment building, I can input what the growth rate is, what the mortgage is, when the mortgage gets paid off, what the annual positive cash flow. I put the expected cash flow. I might put rental property in here and come up with some kind of a number based on their information to me. I'm going to take that out again. Let's see, I just did illiquid assets. Other assets would be if I was going to sell them insurance inside the estate or outside the estate, or whether they were going to make gifts outside the estate. It doesn't have to be life insurance. It can just be a regular gift. It depends on what they want to do. But I get the ability to show them a before and after scenario. Yes, you could do it with cash. Yes, you're going to put it into a trust with cash. The cash will grow, or you can take that cash and you can buy life insurance, or you can do a combination thereof. Or perhaps I might want to make charitable gifts while I'm alive or after I've passed away. Then we go into illustration details. I went through this before. You see this thing right here? Here before I said where the money gets reinvested. This is how to prioritize the use of assets. Okay, so it's giving me a signal. I'm missing an entry. It says the percentages you've entered for reinvestment of cash, excess cash flow must total 100%. So, it only totals 95%. That means I missed the certificate of deposit at 5%. I enter that, and now all of a sudden I can go to the next place. Prioritize the use of assets. If I want to maximize net worth, I click on this button and it will readjust what the order of distribution was, and it will solve for maximum net worth. But if I wanted to solve for increasing my cash flow as opposed to increasing my net worth, I go back over to here, I think. I click on spendable cash flow, I think. Here it is. It says cash flow availability calculator. If I click on that, and then it says, well, the current net worth in year 36 would be $48 million. Well, what if I want to make the desired net worth in year 36 $10 million? And then I calculate that number, and instead of $200,000 a year, I'm going to be able to pull out $340,924 per year and still leave $10 million for the kids. And if some of that additional income I bought life insurance, that number could be 30, 40, $50 million. I'm going to take that out. But think of how long it would take you to play hunt and peck, which is what we had to do originally before they put it into the system. Think how long it would take and how many guesses you would have to make. Let me do this. Desired cash flow. I'm going to put 48,183. 48,183. 611. So I can be back at the same place I was. Now all of a sudden when I calculate based on your input assumptions, no additional cash flow is possible. So I now reverse the situation, and I didn't give it the ability to solve for extra cash flow. So now I'm going to get out of this. I'm back at my $200,000. And literally what I want to do right now is I want to take you to the report selections. I'm going to go to preview of just of the one that we're doing right now. These people are 65 and 63 years old. So I might have lied to you. Let me see. I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. All right. So I've got 11 pages, 12, 13, 14, 15, 16. So I got 16 pages because of their age. I've got only 35 years to age 100. So let me go back here, and I want to show you just how to document where the number comes from. I want you to notice this expected after-tax cash flow. It says $122,000. So all of these, the next pages, I'm sorry, 122,000 plus retirement plan of 77,962, totaling $200,000. I want to go in here. Social Security was $22,000. Work after retirement, 100,000. 22 plus 100 is 122. There's 122. Now let's go to the tax exempt account, 77,962. Let's see. Liquid assets. I know it's going to be here someplace. Oops, I must have passed it. Tax exempt account. Taxable details of the CD, liquid assets. Okay, so let me tell you what I just did is I forgot, and I don't have the tax exempt account being printed out. So now I got to find it in here. Tax exempt, here it is, tax exempt. So I move it back over here, and now I have that page. So I can go back to preview. The tax exempt account, if I remember correctly, was $77,000 and change. So let me go down here, tax exempt. Here we go. Notice here, $833,000 account balance, 77,962 is the tax exempt withdrawal amount. And I still have 755 left over, on which I made 3.5% or 26,000. So remember that 77,962. If I go back into this 77,962, I'm sorry. Here's my 77,962 plus 122. So I can go in and create a credibility piece by saying, look, every number here is basically being validated by the following detailed pages, whether it be equities, whether it be qualified plans, and the same thing here. In year 10, I'm pulling some money net after taxes out of the equity account. Why? Because I had to make column 9, the 269.55, equal column 3, which is the amount they needed, 269.65. So the system does a lot of solving for you. And then when we press the button that says I want to maximize cash flow, it goes into these accounts and it takes out more, just so that we still have $10 million of net worth left over after maintaining my lifestyle. So I'm pretty much done with this, Bradley. What kind of questions have you got?
Well, it's not questions as much as comment. The level of detail that you can use on that software is absolutely unbelievable. The best news is none of your clients generally not going to see any of how you had to load it. Once the data is collected and it's put back in, to be able to sit down with somebody and go through the page that showed the timing, combining, and sequencing, the efficiency of distribution, that is your closing page. But the confidence in knowing, see, I asked you earlier about it because I've been through this so many times with you now, but to go back with the client and say, okay, look, I use this assumption for inflation. Is that a right number? And I've watched the clients do pushback. You know, if you say 3, they say, well, I'm more comfortable with 2.5. Some say, well, I think it's going to be 4. I don't care. It's what they want it to be, right? And when all the numbers are all said and done and their securities portfolio that they assume is going to earn 8%, which we know it's probably not, their figures come back. It's not a problem when they have enough money. See, it seems like a lot of the presentations I've seen are designed around that fear factor, especially with older folks, right? You're getting into planning, you say there's a chance you're going to run out of money. I love it when I look at it and they're fine. I love being able to tell them they're fine. You're not going to, when it's the case, right? You're not going to run out of money. Let's talk about how you can make that more efficient based on what you identified as your priorities and objectives for the future.
So Brad, yeah, it does make sense. And Brad, if you've got a, what we'll do when we come back, because I'd like you to tell the folks a little bit about the center, is we'll talk about how to use this methodology, not just with the client, but with the CPA who you potentially are trying to create a strategic alliance with, or with an assets under management person who would love to be able to expand their practice, perhaps gain more of the assets under management under their management as opposed to somebody else, or maybe even wants to be able to start doing some additional planning to reduce taxes, et cetera. But in the interim, why don't you pull that up and let's tell the folks a little bit about what we're doing with our mentoring group, of which the Wealthy and Wise software is only one piece, but there's probably about 10 or 15 other pieces that are available through us at steeply discounted basis. So why don't you go ahead with that?
Well, thanks, Simon. Listen, those of you that don't know about our organization, we'll tell you a little bit more about it as we go forward. But one of the things that we do is we do these academy events. We do them quarterly. Our next one's June 14th through 16th. They go from 8 o'clock until 8 o'clock a.m. to 3 o'clock Pacific time. And sometimes we run a few minutes over, but we try to stay pretty close to the schedule. You have an unbelievable 3 days of events on things that help to increase your practice income, make you better at what you do, and even help to develop you as a better person. To register for the academy, you can go to our website, www.yourctsr.com, and there's a tab that says upcoming events. It is $645 to attend the 3-day event. First 20 folks that register that are on the call today, you can get $100 off, and we'll share a code with you on how to get that reduction as you move forward. For more information, call us at 877-258-2837, or you can email us if you prefer at the center team at your CTSR. Let me tell you just a little bit about our superstar faculty at the Center for Tax Strategies and Resources. We've assembled some just amazing folks from the industry, specialists in their areas, people including Bruce Givner, who is a nationally recognized tax attorney, probably the smartest tax attorney I've ever met. Who is one of our faculty members. Kevin Knebel, who is one of the experts on utilizing the power of social media. Kevin is a superstar salesperson who can show you how to turn LinkedIn into your personal Rolodex. Simon and I and Todd and Bobby were so impressed with Kevin when we were kind of interviewing him to become part of our academy. We actually hired him as a consultant for our individual practices, and it's been a wonderful experience. We've got Joe Strzeri, who is a nationally recognized tax attorney, creator of the Southern California Institute Laureate Program, which is a think tank for both CPAs, attorneys, financial planners, and wealth advisors. Joe has unbelievable background in such things as succession planning, as well as, of course, all the aspects of estate. But he is just a crazy, crazy smart guy, and we love to have him on the team. We've got Simon Singer, who you heard today, who is just a joy to work with. We've got Vince Dodonna, who's the all-time production leader for Guardian Life. Vince shares some of the tools and techniques that he uses with our members at the academies. We've got Walt Dallas, who's another tax attorney who specializes in tax reduction plans. So going back, one of the services we have for our members is you can review 2 years of your personal and your corporate returns for your clients, get an analysis on what their current counsel may have missed, or more specifically, that firm is built around reviewing and finding efficiencies in regards to, could be tax credits, could be reductions, could be missed opportunities. The nice thing is a report comes back to you, the client's still never written a check, and in the report it shows all the reductions and strategies and what it would cost to fix those things, and you make a decision with your client if it's something you want to move forward on. And that's we've got a couple of CPAs and tax attorneys that do that. Jerry Minardi, co-founder and managing partner of Selling Technologies, which is a video marketing program, little video vignettes that you can white label, put your practice on there, have videos sent to your clients, your prospects right on their cell phone with your logo on there, and they're all topically driven. So it could be issues about estate planning, it could be issues about buy-sell agreements or succession planning. And these are all professionally produced video vignettes that go back out. It's a great way to keep your name in front of clients under favorable conditions. Steve Pasek, who's a CPA and tax attorney who's got his master's of taxation, has done a lot of work with the center. Mark Pace, national expert in life insurance policy management. Dr. Vicki Rackner, one of our all-time favorites. She's a retired surgeon who's devoted her life to finding advantages financially for other current doctors. And she helped build our other program, which is another organization that we're part of that works with doctors in their estate planning. And we have quite a few tools available for that for our members. And then Dan Zeppelin, who has a very unique senior settlement protocol. He's got a bid process that he'll put a policy up should it be ready to be put to market. We have not only tested this prior, but we've used it with quite a few clients, and Dan's delivers incredible results for those clients who are in a situation where they want to be able to sell their existing policy, be it it's either too expensive or it's not needed, but he can turn that into a very valuable asset that the advisors can take those dollars and move to the next step. So that's just a sample. We were always adding new faculty onto what we do for the center, and we have these folks do both live meetings, virtual meetings, as well as breakout sessions for members only. Okay, so Simon, you had mentioned just before we did that little advertisement on the center that you have a way to use this tool quite effectively with CPAs and tax attorneys. Would you share that with everyone?
Sure. I started using INSMARC in 1982, I believe it was, and it is evolved. There are things like documents on a disk, which basically helps new attorneys create documents for every kind of estate planning need or buy-sell agreement need you could possibly imagine. More importantly, it's got descriptions as to what the document's for. We've all been in situations where we walk into a client's office and they've got a stack of legal documents that they've never bothered to execute, even though they paid for, but they didn't know why they did it in the first place. Explanations as to how things work is one way to be able to talk to a prospective estate planning attorney. Not that you're going to get referrals from the estate planning attorney or the tax attorney, but you might very well get referrals to the people that refer them business. That could be CPAs, that could be assets under management people. And when you show them something, the quality of the wealthy and wise system that we went through just a few minutes ago, people typically don't want to look through details. And so when we start showing them all these various alternatives, no longer are we just an assets under management person or just an insurance guy. We actually know how to help do planning, and the software does a lot of it for us. So when I walk in, and if I remember correctly, let me go back to that screen and I'll be able to tell you more closely. I think with these people are 35 years old, I think there are, I'll tell you in 1 second, or more than 1 second. So there's 15 pages, most of which is documentation. So here it's showing the total estate assets, the transfer taxes. Here it's showing all of here's the hypothetical net worth broken down into illiquid assets and retirement plan assets and taxable assets and tax exempt and equity assets, and coming up with totals, all which were verified in previous pages. Here's the summary of liquid assets. When you start walking in and start talking to professional advisors about turnover rates and how to be able to show the effect on the overall portfolio performance, it's not just yield, it's costs. Sometimes the costs are in management fees. Sometimes they're in short-term capital gains or long-term capital gains. Sometimes it's in turnover. And nobody else but this system knows how to be able to illustrate. When you show their qualified plan money that started at $900,000 and grows at 8%, but when it's taxed, here's the sum total of all the taxes. I want you, this is important. Here's the before tax required minimum distribution. Here's the before tax distribution, and here's the after tax cash flow. So if I take the required minimum distributions of $4.8 million and have $3,100,000 in after tax distributions, that means I paid over the course of the years $1,700,000 in total taxes. However, there's still $2,700,000 left over. And when I pass away, the Internal Revenue Service comes along, and on my final tax return, they have something called IRD, income in respect of the decedent. In this case, it totals $2,700,000. I'm going to be simplistic. In a 50% tax bracket, that's $1,350,000 of additional tax in addition to that $1,700,000. Well, 1,000,007 plus, what did I just say? 1,350,000. So that's $3 million in taxes on an asset that was originally worth $900,000. That's twice as much in tax as what the asset was originally worth. And if I go to the spouses, this was 750,000. There's 1,125,000. So it grew, but I wound up paying $2,400,000. I'm sorry, yeah, $2,400,000 in tax. I pay more in taxes than what was in that retirement plan to begin with. That's a billable event for a CPA to do with his clients that you can do in the background. He could charge his clients $2,500 or $5,000 to run those analysis, and you could do it in the background for $1,500. So you're generating fees from the CPA, and you also would more than likely get your share of those kind of clients to talk to do some actual planning on, each step of which creates additional revenue for that CPA. So if there's a family limited partnership, that's another tax return. If there's an irrevocable trust, that's another tax return. If there's an insurance policy, there's an analysis that you know how to do that talks about the financial viability of 1,500 different insurance companies. That's another thing that the CPA can charge for. So when you become an adjunct business development department for that CPA, let me suggest to you that your phone rings more often than you want it to. Part of the problem is telling the CPA not only what you do, but what you don't do. It's important to know what the CPA does. Does he know anything about defined benefit plans? Does he file those tax returns, or does he rely on a third-party administrator? Has he ever thought of putting insurance inside of those plans and buying insurance with pre-tax money, which will help to increase the net after-tax distribution from that defined benefit plan by 30%? You walk in with 15 to 25 pages of documentation on his client for each of the scenarios. All of a sudden you become a valuable asset. We can teach you how to do that. It's part of the way we were able to get this national firm to help us put together this National CPA Alliance program. And I'm telling you right now, that's not perfect either. But I can tell you, for years, I did continuing education for CPAs. I was approved to do that in the state of California and could have been approved in any state in the union that I wanted to. But what I found is when I was doing those continuing education meetings, I was not getting the Rainmaker CPA. I was not getting the managing partner. I was getting the third and fourth level accountant who had just been hired out of school, who did all the grunt work, but they're not the ones that control the client. I want the ones that control the client. We also created some software where where the software will go into each and every type of tax return that is basically referenced in the client's taxes and figure out just how much money they have in tax-free bonds, how much money they have in qualified plans, where's their income from, what's the opportunity, what age categories, et cetera, et cetera. This is just one of the more amazing systems you've ever run into. So I know that I'm selling hard because I think that everybody on this call really should pay.
I'm not even laughing at that. I'm impressed since 1966, you're still as passionate as you were 12, 15 years ago when I met you, as you were yesterday, as you will be tomorrow. You love this stuff and it shows. This is amazing things you can do for a client. It's a great way to be able to build your practice up. You are seeing one sliver of the things that we do with and for the members to help develop their practice and have access to people who actually like what they do, are honest and ethical. It can help make you better at what you do. So let's put that academy up there a minute. Let's talk a little bit quick recap on that, and we'll let you go. We're really glad that you're able to spend some time with us here. We hope you found some value in it. Again, the Center's Virtual Academy is June 14th through 16th from 8 to 3 Pacific. To register, hit our website, www.yourctsr.com. $645. Simon, can you check the counter? Have we got anybody left on that first 20? I know 13 were gone.
Actually, my counter, Todd, just left the room. I think he went to the men's room, so I'm not going to bother him right now.
Okay, I don't really want you to. Thank you. The next few people who join will get $100 off. There you go. For more information, call us at 877-258-2837, or if you prefer, you can email us at thecenterteam@yourctsr.com. By the way, if you just have questions about this or about the organization or center, feel free to reach out to us, send us an email. One of us will follow up with you. We've got a team to answer any questions you might have. And with
Brad, am I correct? it's 21 hours. Is it 21 hours of content or just 21 hours of elapsed time?
Yeah, it's 21 hours of content.
21 hours of content. The two attorneys each charge in excess of $800 an hour, and we have them not only making hour-long presentations, we have each of them doing breakout sessions for our members as well.
We got like 6 hours of attorneys just right there.
Yeah. Tax reduction plans, what that does is it increases a client's budget that allows them to be able to give you more assets to manage or to buy insurance or do estate planning. It just opens up a whole different discussion. And I've been in this business a long time. There is nothing that's even close to this organization.
No, that's not. This is fun for the members. It's fun for us. So if you want to find out why we like it so much, you want to find out how to add more practice to your income, find that coaching and mentoring. What we like to say is, you get to be independent without being alone. If you want to see how that can make a difference in your practice, we're quite sure we can show you how to add a few $100,000 a year to your income. So attend the academy or send me an email to the Your Center team at ctsr.com. We'll answer any questions you might have, and hope you have a wonderful balance of your day. Simon Singer, thank you for taking the time to go through that incredible program on Wealthy and Wise. Everybody have a good day.
Thank you, Brad. Thanks for helping.